Hey, what's up guys? Today's topic is probably something that you've at least heard of. That's right, I'll be talking about registered retirement savings plans, or otherwise known as RRSPs. So you've probably heard of the acronym RRSP before, whether it was from your friends and family, or maybe it was in the media, or maybe your bank teller mentioned it to you in passing the last time you visited a branch. RRSPs are pretty simple in concept, but there are many pitfalls to watch out for before you start contributing to them that you should know about. So in concept, an RRSP is a registered investment account that you create with a financial institution. So that could be your bank, it could be a credit union, or whoever you do banking with. And within this registered account, you can buy and sell your investments. And these investments could be publicly traded stock, they could be mutual funds, they could be bonds, they could be real estate investment trusts, stock options, and that's just to name a few. The amount you can contribute to an RRSP is calculated as a percentage of your earned income during the year. This is basically income from active sources such as employment income or self-employment income. If you receive dividends, investment income, or capital gains, those do not get included in your earned income calculation, so you don't get to create extra RRSP contribution room with those types of income. For 2020, the contribution room is the lower of 18% of your earned income during the year, up to a maximum of $27,230. Now, the benefits of using an RRSP as opposed to a non-registered investment account are the tax benefits that come out of it. For one, any contributions that are made to an RRSP by March the 1st of the following year is deductible for tax purposes on your tax return for the current year, as long as your contributions meet the deadline. You don't even need to purchase investments within your RRSP. All you need to do is make a contribution. So let's start off with a simple example of this in action. Let's say you grossed $50,000 this year and you were planning on saving $5,000 either in an RRSP or a non-registered account. And let's say your tax rate was 25%. Now, if you put that $5,000 away in an RRSP, you would get a $5,000 deduction this year on your taxes. That means you would be paying taxes on $45,000. So at a 25% rate, your tax bill would be $11,250 for the year. Now, if you were to save that $5,000 in, let's say, a savings account, which is a non-registered account, you wouldn't qualify for a deduction. So your taxes would be 25% on the $50,000 of gross income, and your tax bill would be $12,500. That's a difference of $1,250 between taxes on the RRSP and the non-registered account. So let's say you were expecting a refund. That means if you contributed to your RRSP, you would be receiving an additional $1,250 from the CRA when it comes to getting your refund. So that's the first benefit. So the second benefit to using an RRSP is the investment income that's earned within the account are tax-free. That means you get to fully leverage the power of compound interest. So let's take the same example as before. That $5,000 contribution that you made to an RRSP, let's assume that you get a 10% investment income return on that. So in year one, your $5,000 contribution would generate you $500, and all of that would get reinvested in year two. So in year two, you would start with $5,500. However, if you put that $5,000 into a savings account, which is a non-registered account, that $5,000 would generate you $500. However, your tax rate is 25%, and that $500 investment income will be taxed. So you're left with only $375 after taxes. That means in year two, you're gonna start out at $5,375 rather than $5,500. And over time, if you make consistent contributions, that's gonna amount to hundreds of thousands of dollars. So RRSPs sound pretty fantastic, right? Well, there are some drawbacks that you should be aware of before contributing to one. First of all, any withdrawals from an RRSP is considered income, so they will be included on your tax return. And secondly, even if you have no income, let's say you got laid off or you're taking a sabbatical, any withdrawals from your financial institution from your RRSP will be subject to a withholding tax. And of course, when you file your tax return at the end of the year and you have no other income, the CRA will refund you that withholding tax. But that's just something to note. Now, the taxes don't apply to you if you're withdrawing for the purposes of using it for the home buyer's plan. But that's another topic that I'll cover in a future video. So the second drawback is when you make a withdrawal from an RRSP, you will lose that contribution room forever. And the reason why is the CRA allows you a tax deduction when you first make a contribution. And they're not gonna let you abuse the loophole of making a contribution, then withdrawing the money, and then contributing again for another deduction. However, they're going even further than that. They're not letting you recontribute, even without a deduction. Now, the third potential drawback of an RSP, well, it's not really a drawback at all, it's more of something that you need to consider before you make a contribution, is the value that the tax deduction will provide you when you contribute. So for example, if you are in a lower tax bracket and you made a contribution, it's going to provide you less savings in taxes than compared to someone else who makes the same contribution but is at the highest end of the tax bracket, simply because they're paying more percentage in taxes. So you really need to assess, where you are currently in terms of your income and where you're going to be in a few years' time, and whether to save that contribution room in RSPs for future use or for current use. So now that we've looked at the basics of an RSP and understand the benefits as well as the drawbacks of using one, we can really see who this is for. The concept is to defer taxes when you're in a high tax bracket. So for example, your investment income will be tax sheltered, you're going to get a deduction on your RSP contributions. And when you withdraw, you should be withdrawing when you're retired and in a low tax bracket. Now, that's not to say that you shouldn't make any contributions at all when you're young, but you should really consider whether you should be taking that contribution as a deduction on your tax return. Because if you don't, it can be rolled forward for future years to be used when you're in a higher tax bracket. You should treat the money that you've contributed to an RSP as being locked away until retirement. And if you need to use funds in a few years' time, then an RSP is not for you. You should really be looking at a TFSA or a non-registered savings account. Now, I will have a comparison of TFSA versus RSP in a future video. So that pretty much wraps it up for RSPs. If you guys found my video to be informative and learned something new, please be sure to give me a thumbs up and hit the subscribe button if you want to see more personal finance videos in the future. If you have a question, please be sure to leave me a comment below, and I'll see you all in the next one.